All right, everyone. It is showtime. It means Wednesday. We are here talking retirement. And Dave, welcome to the show.
Well, thank you. Thank you. Glad to be here.
Wait, where are you? Because that does not look like your main studio.
Yeah, I am in lovely Las Vegas this week. We've got some meetings with clients. We've got a symposium we're going to, and super excited to be in 100-degree weather. It's been a while since I've been back in the heat.
So, how is that heat compared to, your typical day there in Tennessee?
Well, because of the humidity, you sweat a whole lot more in Tennessee. I will say that when you look at 100-degree dry heat, it's, in my opinion, not as bad. I mean, it is definitely hot outside, and it's down 15 degrees from what it was last week. So I'm grateful for that. But it has definitely been a hot one here in Las Vegas.
Well, I'm grateful also for your time that you can spend with us talking retirement. The show is amazing. We get so many great questions from the show. We pull from webinars, and we also get from those that are joining us live. And again, welcome to all those that are with us live. We're so grateful to have you with us. And it's always a pleasure to have you come on and ask your retirement questions. So anytime throughout the process today, if you have a question or we talk about something, you said, yeah, I want to ask more about that. I mean, it could be anything from Medicare, it could be long-term care, it could be reverse mortgage, Social Security, anything. If you have those questions, go ahead and chime and send that in, and then we have a break. We'll jump on and answer those questions. Dave, tell me the best part about this show. What really excites you?
The best part to me is we're answering people's questions. That's one of the biggest things we see from retirees and those who are trying to plan for retirement. They've got a lot of questions they're struggling to get answered. And this show allows us to get to the bottom of those questions, allows us to get people information that will help them hopefully make better decisions as it comes to their retirement.
And today we have a really great topic. And again, feel free to throw any questions you have as we're going through this topic. But Dave, today we wanted to talk about a very particular topic that you cover with Tom Hagna. It's called Paychecks and Playchecks.
Yes, I love Tom. You guys had an opportunity of working together yesterday on a webinar, which was great. I got stuck at the airport. One of the challenges with traveling now, it's like everything else in our lives, there's just not enough people working to facilitate the demands of the people. And so rent-a-car lines were super long, challenged to get where we needed to be. So you had a chance working with him yesterday. But in this book, that it's based upon a book. Now we teach a webinar on it with Tom. But in the book, it talks about the importance of having paychecks during your retirement, something that many people don't think of. They spend their whole life taking their paycheck, spending and saving some. But once you get into retirement, all you've got is this savings account you've been building up for decades. Many people find it hard to spend. So what we do is build a paycheck to where you've got that monthly income coming in, and then the rest of that retirement money can be used for shock or aspirational expenses.
And today, Dave, I pulled a lot of questions from that webinar. And so we want to go through and ask a bunch of those questions and see if you can go through and answer those for us. And so before we get started, once again, I just want to let those know who are watching live, go ahead and submit your questions. There's a lot of questions today, especially we'll bring up a lot about annuities. I think that's something that it was really interesting, Dave, when I was talking with Tom and Autumn yesterday as we were behind the scenes. She said, I have never heard the concept annuities before. And I was so excited about this. I was so intrigued that I had to go and rewatch his podcast, Paychecks and Playchecks, or his webinar, just so I could understand a little bit more about this. And she goes, where's this been hiding all these years? And as you know, from being on the shows with Tom, it's been around forever.
Yeah. Yeah, it has. In fact, unfortunately, because it has been around so long and many people have used them incorrectly, there are many people that have negative connotations as you look at the word annuity. But what we're finding is it's really the true path to a safe and secure retirement, that if you don't have an annuity inside of your retirement, the risks you're going to face are going to be higher, and the performance oftentimes that you're going to get out of your retirement assets is going to be lower based upon normal asset allocations that happen as we get into our retirement years.
And Dave, let's just get right to it with Thomas. And he said, what are the risks to annuities?
The biggest risk when you look at an annuity is the fact you are tying up your money. Now, that doesn't mean that you've annuitized the product, and you don't have to do that. Many of the annuities now you can build throughout your lifetime, end up transferring that balance over to your children at death. But the biggest issue is you can only get out 10% per year in those initial years without having any type of penalty. So if someone's saying, hey, I'm going to put money into here and I may need to pull 50% of it out tomorrow, you're going to have a problem. But a couple of things that I would tell people: number one, if you're putting money into annuity, you better be doing it for long term. I would never recommend anybody buy an annuity that wasn't structured for the purpose of being 1 or 2 years. I would never recommend that anyone buy an annuity for a short period of time. And number two, for most people, this is retirement money. You want that money to be in there. You shouldn't be pulling your retirement money out. You need to let that money go. It should be a bucket that you just turn your head to until you get into retirement, and let it just keep building until it gets to a point you have the money you need.
And Dave, you talked about this a little bit as we were getting started, but what's the negative feeling people have with annuities, and why is it so bad at the beginning as you were talking?
Yeah, there's a few things that have happened. Number one, the insurance companies that had these products a decade ago or 2 decades ago, many of them were designed to where they really did benefit the insurance company. They wanted to ensure that they got the rates of return they needed to be able to take care of their companies. Now, another one is you had many salespeople that didn't understand them either. So they were selling products to people that they didn't understand. Therefore, they were getting people into products that weren't appropriate for the individual situation. But these things have changed. These insurance companies now have had a lot of experience in the annuity market. They've been able to get way more competitive in the way they operate. They use the benefits that they offer to maybe lower a rate of return that you would typically get in the market, but you're also not going to go down with it if you have a fixed index annuity. And advisors are getting smarter. Now, it doesn't mean everyone out there knows what they're doing when it comes to an annuity, but advisors are getting much smarter as well.
And Dave, I think we also need to bring up that annuities, they're not the same. I mean, even within variable and fixed annuities, there's a number of differences. And I think what you're trying to say here is you need to do your research before making any decision.
Yeah, absolutely. It's like going to the store and you need to make a cake and you just start grabbing stuff off the shelves. You're going to just grab it. It's all food. It's all food that you could eat and be consumable, but that cake's going to turn out horrible if you don't have the right ingredients. And it's the same with these annuities. They're all annuities, but if you're not putting the right ones together in your retirement plan, you're not going to achieve the success that you're really hoping for.
And Dave, let's jump over to Heather's. I'm trying to curate these a little bit to kind of go as we have our conversation here. But Heather's saying, at what age would you create an annuity?
Heather, you can do this at any age. I will tell you, for most people, they're not starting these usually until somewhere in their 40s. And why is that the case? Because an annuity is a true retirement asset. Many times for people in the 20s and their 30s, they're trying to figure out how they buy a house. They're trying to figure out how they pay for kids' college, maybe, whatever the expenses may be with the family during those early family years. So if you're at a point where you've got enough money in your 20s or 30s where you can put substantial amounts away for retirement, annuity can be a great thing for you at that age. What we find, though, is that most people are able to put into their Roth accounts, invest in other assets until they get into their 30s or 40s and 50s usually. And then at that point, they start transitioning into the annuity products.
And Dave, I think this is the number one question as I was going through and polling questions. Everyone was asking about age. And I think that's an appropriate piece to talk about because, again, everybody's saying, well, what if I start too early? What if I start too late? Where does this put me? And so I think that's one of the things I'm glad we talk a little bit about.
And I haven't really thought a lot about this, but I know it is a question we get asked all the time, even with life insurance retirement plans. What age can I get started in these? And the issue isn't that you're starting too early. I think many people are hoping they can delay the process, maybe even that somehow their retirement's going to turn out better if they wait. Well, you really can't start too early planning on your retirement. Now, there can be positions where it'd be too late, but with an annuity, I mean, you find 90-year-olds, based upon the way the annuity contract works, they may be able to get far more out of the money they have by putting an annuity in than they could ever get out of just taking the money out on an annual basis with typical withdrawal rates.
And Dave, I want to bring up a question because, again, as we talk about the good and bad, this is the one from Lance, and he's asking, what happens if the annuity provider fails? Has this ever happened?
Lance, it has happened. There have been insurance companies that provide these products that have failed, but I'll tell you a couple of things that happen. Number one is there is a state insurance fund that steps in and bails these companies out. Now, they may not have all the money that they need to be able to solve the full issue. So then what happens is these third-party companies come in, other insurance carriers come in and bail them out. So although we've had companies fail, what we haven't had is people missing out on their annuity payments because of the way they're structured, that the state's either going to make those payments or another insurance company is going to step in at a discount from the state's going to take part of the burden, and then that new insurance company is going to take part of the burden, and you're going to get your payouts.
Dave, what happens if we don't sign up for annuities and we basically just end up taking a long time to make that decision? I mean, does it really have a big effect on us?
It can, depending on what you're trying to accomplish. If you're trying to accomplish income streams, absolutely can affect you. We've got annuity products with companies that we work with that are really designed as an income product, that you are going to annuitize that. You're going to take monthly payments out of there every month throughout the rest of your life. The sooner you can get money into those accounts, the more that value can grow. And some of these have a lot, large bonuses. They may have even a 250% bonus that goes into these products to allow you to get more out of them from an income stream. So yeah, we want to be careful of waiting too long. Now, does that mean that if you were to put annuity in your 70s that it couldn't work out well for you? Absolutely could, but it may limit the companies we're able to pick from, the products we're able to choose to really help you get where you want to be.
So, Dave, if annuities are so good now and it's such a great opportunity for us, why is not everyone signing up for them right now?
Because it's hard to get that information out to people. I mean, once you've turned your back on something, it's really hard to get people to change their attitude towards what it is. We see it inside of government systems where they're trying to change things that have been designed that way for decades. Really hard to get people to change. You look at even Roth accounts. I mean, Roth accounts it's been hard to get people to contribute. The government's actually taking steps now to get people to put more money into Roth accounts, but it's because the original accounts started back in the 70s. Roth didn't start until the 90s. So they had a head start on it. And that's what we're finding is people just aren't taking the time to educate yourself. If you've made up your opinion about something, it's like a food, and you don't like radishes. Let's say, hey, I just hate radishes. Well, the minute radishes are brought up, most people are like, hey, I don't want anything to do with it. Don't even want to talk about it. But somewhat like food, we're told that our taste buds change every 7 years. That I find foods I really like now that I didn't like when I was a kid. If I open myself up and better understand what's there and mix it in maybe with some other foods, can work out very well. But that's the big issue. People just aren't taking the time to educate themselves. They're turning their nose up the minute they hear annuity name and don't realize that those products have changed drastically.
And I want to remind everyone, if I could speak today, that if you have comments or if you have questions on annuities, it could be on anything with long-term care, Medicare, all of those, please go ahead and submit your question, and we'll be able to go ahead and get all those put into the system here and be able to get that taken care of. Dave, I do want to ask you, you started out the show talking about traveling and all the different things we're facing right now. And I want to bring up Van's question. He's saying, do you think we are going through a roaring 20s with the depression following? If so, how to prepare?
Van, personally, I do. I do think we're going to have a major correction in the market at some point. I'm not alone. There's a ton of top advisors that believe this is the case, a ton of top educators that believe this is the case. How do you protect yourself as you get in principal protected products? You've got to get yourself into assets where if that market does drop 20, 30, 40%, you're not going with it. Now, for some of you, you'll be young enough, and I don't know what your age is, Van, but you may be young enough where you can ride it out. Even if you were to have a big drop in the market, if you're in your 30s or 40s, you don't need that money for another couple of decades. You would be in a situation, you could probably ride it out and the market will come back. But if you're sitting there in your 60s, having to take distributions out of this money and it drops 30, 40%, you could completely wipe out an otherwise well planned out retirement within a 12-month period of time.
I think it's a very valid point. Dave, I do want to bring up Gary's question. Gary's joining us live from Facebook. And his question is, in light of Tom Hegna's annuity presentation, do you think that it's too early for my 36, 38, 40-year-old children to invest their retirement assets in Roth annuities? They have already maxed out their $58,000 contributions to their mega backdoor Roth 401k accounts and their $6,000 IRA accounts, where they have invested aggressively and speculatively.
So first off, Gary, welcome. Glad to have you with us today. I'm one short flight away from you. I think there's probably got to be a direct flight to San Francisco from here. I should have tried to plan it into my schedule so we could have gotten together for lunch. But in regards to your question, so remember here, when you look at what's being done, your kids sound like they're in a great position, and congratulations on having kids that are financially responsible. But if they're getting all that money into these accounts, now what they've got to do is pick how they spend that money. How do they not spend it, but how do they invest it? So for them, I don't see an issue with putting some of these annuity products in place at their ages if they're setting themselves up this nicely inside of that Roth with the money they have. Now in the 401k, probably are not going to be able to access an annuity through there. So it would have to be with the IRA money. Not sure how much they've got in there, but would not be a bad idea to protect that even at their ages and allow that to grow and get themselves in position where they had some good income streams going into the retirement years.
And Gary, I did see you on that webinar yesterday as well. I was on there with Tom yesterday, so it was great to see you on there. And it's always great to have you on our Facebook and YouTube live shows. So we definitely appreciate it. And Dave, it looks like he wants to have lunch. So you've got to get that worked out sometime.
I do have to get it worked out. I'll tell you, if my week was not so busy, I would fly up there over the next few days if you're available and would make it happen.
And Gary, again, thank you so much for your question. Thank you so much for being here. And for those, please continue to submit your questions. And Gary, if you have a follow-up question, like always, please go ahead and get that submitted. Dave, let's jump down to my next question here from Stryker. How does low interest rates affect annuity returns versus rising interest rates?
Very good question. And this is something we get asked on a regular basis. So we don't get a ton of questions on this. But what you need to realize is that when we look at payout rates now, because of where interest rates are, they're the lowest they've been in history. When we look at what's going on, the lower the interest rates are, the less annuities are in theory paying out. So we look at it right now and say, look, these annuity products are doing very well, even against an interest rate if we had it of 2 or 3%, if it were that high. So once that goes back up, especially for those in a position that are either in a inflation adjusted annuity or in a position where they haven't annuitized yet, we see huge opportunity for people to be able to get even higher payouts in the future because of what's happening right now.
So Dave, are you saying that anytime, even if the market changes, we're going to be okay?
Yeah, we are going to be okay if we're structured correctly. And again, if you've already annuitized your product, it really doesn't matter. I mean, at that point, you're getting your dollars, whatever it is the annuity company agreed to give you, and any loss or gain on the backside would be their issue. So really all about where you're at in retirement. But that's where annuities work so well, is because there's so much freedom with them, and there's so much opportunity to really take out some of the risks and to get these rates of return that currently are exceeding most bonds.
And Dave, let's jump down. I want to get Kim's question in here as we're kind of moving along time here, but she said, I'm curious, can you give us an idea of how much a fixed annuity would cost?
Yeah, I can give you an idea. For most of them, nothing. I mean, this is something that many people don't realize. They think there's these large fees of going into these annuity products, and they're spread products. So what they're doing is, yes, the annuity company is getting money off of the process, but it's for the risk they're taking off the table for you. So you're not going to pay anything. They're going to agree to give you X dollars on the annuity if you annuitize it. If not, they're going to give you illustrations that are going to show, based upon historical rates of return, where you're at, what that's going to be. Now, there are products that you can pay fees for to get a higher performance. And there's times that we would recommend that to people, saying, hey, based on the performance of these companies, if we look back the last 10, 20, 30 years, and we look at what the fee would be that you would pay, well worth the rate of return that they're giving you for that additional fee. So, but for most, no fees at all. I mean, if you look at them, that's one of the great things about fixed annuities, and one of the things most people misunderstand about the way they work.
And Dave, with a fixed annuity, is it, because I know some of them may be a good option if somebody's kind of more risk adverse, is that kind of fall in line with that?
Absolutely. Absolutely. And again, there's all kinds of annuities. It's like going to the store and don't want to talk all about food today. I'm not sure why we're on the food topic. I've already had breakfast, so not that I'm hungry, but again, if you're going into the store there and you're wanting some type of dessert, there's 100 different kinds of desserts in there. They're all desserts, but there's cakes, cookies, pies, whatever the case may be. Well, again, they're all annuities, but they're different products. And it's important. This is where it gets missed, CR. People get out there, and unfortunately, from an advisor standpoint, I will tell you this happens, and people know it happens. They get in position where they're going to get a larger commission by selling a given product. So what do they do? They sell a product that really doesn't fit the individual situation. They don't take the time to go through and understand the whole plan that they should have. They don't understand what the persons themselves are really trying to get to. They just know, hey, annuities are good. I can make a lot of money. I'm going to sell this. Well, that's where the problem falls. What you want to do is get with someone that can educate you on the products, that's in a position where they're looking out for your interests, not their own, saying, look, we've got to get the right product, because we don't want buyer's remorse. I mean, that's one of the things we talk about all the time when we do our planning. It's like, look, take what time you need. If you need more education, let us send you books. Let us do different face-to-face events with you. Let us put you on a webinar, whatever the case may be. I don't want you coming to us, getting into a product, and then wishing at some point somewhere down the road you hadn't done it, because our goal is to get you to a safe retirement, not to have you feel like somehow you got misled into something that's not going to work for you.
Dave, I love how you explain that, because that's exactly what we're trying to do, is help people become more educated so they can make the best decision. Because you're right. When you're working with an advisor, a lot of times you feel like you were talked into a product, you felt like you were backed up against a wall, and you have to pick the product that they presented versus the options that are available. That's the one thing that I'm very grateful to be part of this team for, the education piece, because education is power. And I think a lot of people need to understand that.
One of the comments we get a lot in our planning now is people like, I'm so sorry I'm taking up so much of your time. It's taken me a while to get my hands around this. And we always tell them, it's like, no, please do. We would feel bad if you didn't take time, if you rushed into a decision, because we know if you'll take the time, you'll study it, analyze it, you're going to get to a point where you're going to feel comfortable with it. And once you feel comfortable with it, then at that point, we know that we've done the right thing, because we've got you to a point where you can see the vision that we saw for your retirement when we started putting it together.
And Dave, how do people get time with you? Because we talk about making sure we get the right product. We want to make sure we have the right advisor. We want to make sure that we use time wisely. So what's the best option for somebody that says, Dave, I get all this, I'm ready to make some changes in my life?
We do have the option for a no-fee consultation, complimentary retirement session, where we'll talk to you about the questions you have. We'll also talk about how we work. Now, I may or may not be in that meeting at this point. We're getting to a point that I'm not able to make all of those. If you agree to move forward, at some point, I'll be involved in that process at this time. Again, may not be in every meeting. There are things, we've got great advisors that we work with that are part of our team that can help explain the same things that I do. But if there's a situation where, especially when we get into government programs, I know a lot about Medicare, Social Security, some of that stuff, happy to jump in and make sure people understand it. But it's really through our website. You can come get all the information you need through those meetings with us and see if we're a good fit for each other. This isn't a guaranteed thing either, even on the person that's coming to us side. We've had situations where it's like, look, you don't really need us right now. This is what you need to do. Here's the recommendations we'd give you. Come back to us maybe in 5 or 10 years, or maybe never. Maybe you're in a position that you've got everything laid out already and are in a good position. Hey, we're fine with that. Continue to educate yourself. And if you have questions, let us know, and we'll be here to help answer those. OCR, I think you hit mute.
All right. Can you hear me now?
Yes.
Okay. One of the things I really love about what you're talking about is really diving in and getting those questions answered. And that's what Gary's on here. We love Gary. Gary's a regular of the show, and we're appreciative of him and his questions. And he's saying, my 3 children each have $1 million of Index Universal Life long-term care rider for the life insurance retirement plan. When presented with a choice between purchasing an additional life insurance retirement plan versus long-term care rider, the LIRP, and a Roth annuity, in light of limited funds, which one would you recommend?
Yeah, a couple of thoughts on this, Gary. Number one, you've definitely got enough money there to cover a long-term care event. So from that side, I'm not overly concerned that we would need any additional insurance for long-term care. Now, if they need for some reason, or want for some reason, more than $1 million of insurance coverage, yeah, you may want to look at that. But I would say in this situation, I would try to get that money into the annuity. Now, with that, again, you've got to look at the other assets they have. We want to make sure we're not over principal protecting, so we're getting that stock growth as well, which I assume you've gone through. But if I were to look at this situation, just knowing what I do without knowing the assets they have, the income needs that they would want during the retirement, the amount of money they'd want transferred potentially to beneficiaries, I would say, hey, let's take those Roth accounts, let's start building those up, getting some annuity money in some of those, and maybe even, again, just leaving some of that in the market, depending on how much is going into this $1 million LIRP.
And Gary, we hope that answers your question. We love these questions, Dave. They're so great to get all these questions in as we're able to go through. And like you said, just help people get closer and closer to retirement and make the best decisions.
Absolutely. All
right, Dave, let me jump down to see Janice. We've got a few more minutes here. How can you find out what an insurance company's rating is?
You're going to need to go online. So you can go online. There's 3 different companies out there, Standards & Poor's, Moody, and I can't remember right now what the other one is. but you can search those up. They'll rate them by different methods. You just need to look based upon the method of how they rate. You'll be able to see what these insurance companies rate as.
And Dave, with that one, Amber's also kind of in the same area. So I wanted to bring her question in. Is there an independent company that rates insurance companies? So she's talking about, I don't want to call it a watchdog, but non-biased.
Yeah, and that's what these three companies are. That's what their purpose is to really take the financial strength of these companies, what's going on inside of them, and then rate them accordingly to the risk that they would have of failure. And again, we look back and we say, hey, there's never been a time where people have lost their policies, the premiums they were supposed to get, or the distributions that they were supposed to get out of these policies. But still, you don't even want to have to go through the process. So I would recommend that you get with higher rated companies, so you just don't even have to worry about it.
And Dave, with all the companies you're part of that you work with, what rating and how do you figure this piece out for you and the rest of your team to make sure you have the right people around you?
Yeah, there's a couple of things we look at. One of them we want to look at is Comdex score, which is a numeric score that they're going to be given based upon a number of factors. We're going to look at that. We're also going to look at the strength of the company. I mean, we're working with the largest insurance company in the world. One of the providers we have. We're working with one of the largest fixed indexed annuity provider in the country. I mean, these aren't small companies. And the great thing, we're independent. We get to choose. It's not like we're locked into some given product and we have to sell you that product, even though it may not be as good as another product. We have the freedom to go between companies, to be able to work with 50 different insurance companies that offer great products, and to be able to adjust our planning as needed.
And I think that's one thing that can bring comfort for those that we are working with and talking to, is that we're really doing our due diligence on the back end to make sure we have the right companies that are going to be able to help you. Because a lot of times, Dave, if they find somebody on their own, they still have to go through somebody. Even if you're out there doing all that work, you still have to be able to be paired up, because if not, you're still going to make bad decisions. But plus, a lot of companies won't take you unless you have somebody with you.
Yeah, it's always a problem with captives. And I'm not saying that they're wrong. There's many captive insurance companies out there, and I'm not here to bash on by any stretch any other advisor, but we often have conversations with them, and it gets problematic at times, because if that company denies someone, let's say for a health issue, they're stuck. They really can't give any other options. Well, if we have a company that denies you, we may have other companies that are willing to take you, even with the health issues you have, and we can go shop those. Same thing on rates of return and the structure of the policy. If you can't solve the issue with the policy that's being offered by the company you're working for, all of a sudden you're stuck. And I guess that's where, on my mind, from an independent side, I like it. I want to have the flexibility to be able to give people the right product regardless of their situation.
And Dave, I think we're going to try to squeeze one more question. This one's pretty long. We're going to get it from Jeff here, so it's a two-part. But Jeff is asking, why can't employers offer X amount of retirement income per year as a retirement plan versus a 401k? For example, purchase an annuity for $1,000 to $5,000 of annual retirement income, so that after 20 years, an employee has a guaranteed $20,000 to $100,000 of income annually in retirement. Not sure what the amount should be, but would the concept work?
The concept definitely works. It was called a pension plan. I mean, if you look at it, that's exactly what it was. It worked very well. Excluding companies hated to have the responsibility. So what you're talking about is a pension plan, and they do work. It's just no employer wants to have to deal with all the administrative side, the future liability that they have on the top of those. So you see 13% of Americans that get them now versus the 70 or 80% that used to get them.
So Dave, is that why we don't see pensions anymore? I mean, even through the government or anything else, I mean, that's really, we just don't see them anymore.
Yeah, and the ones we do see are underfunded. So it's just the big issue of how do we deal with what's going on and what we made promises to, especially in an uncertain economy. In fact, we've seen recently there's been changes in laws that are being proposed to help secure many of those underfunded retirement plans. Well, to me, that's problematic. I mean, I've lived in Utah most of my life. I've been in Nevada. I've been in Tennessee now, Puerto Rico. But if you've got someone in New York that's pension plan's going broke, I'm not sure I should be the one that needs to pay for that. I had no involvement in the laws that you established. I had no benefits that ever came out of anything. Why should I now be responsible to make sure you get your retirement check? That just doesn't seem ethically even right to me. But yet that's what's being proposed at this point, because that's what's happening. And these companies are just trying to get away from them so that they don't have to worry. You can put in a 401k and that's your issue. Hey, if it works or it doesn't, good for you if we don't have to worry about it once you're gone.
So Jeff's on the right path, but again, we're trying to figure out the next strategy. And so if pensions on their way out, or like you said, there's a small percentage, we've got to be able to make sure that we can control what we have in our possession or in our opportunities today, versus saying, well, maybe I can find the job that has this or this. It's really taking advantage of what we can do today.
And truly, CR, I'd rather have the freedom to do it myself anyway. I mean, again, if you look at it, get paid appropriately for what you should be getting paid for, take your own money, invest it, and then use an insurance company that's much more secure to be able to put that money in it. In theory, truly, that's all Social Security is as well. You're taking money out of your check, putting it in a big fund, and they'll promise you X dollars once you get into your retirement years. So the concept, exactly what he's talking about, is great. We wish everyone had consistent income, but I don't think at this point I would want employers to be responsible for that anymore. Now, it's hard because people aren't taking the responsibility themselves. They're struggling. And as a result, we've got over 50% of Americans have less than $1,000 saved for retirement. But we need to take it back ourselves and start making those commitments to our own future and start making sure that we're ready for that time of our lives.
And I'll definitely give kudos to Gary and his kids, because they really are showing us, like you're saying, doing it on our own. Make sure that we're really putting that effort in now so that we have that ability to retire when we want to. And I think that's very appropriate. A great way to end the show, Dave. And thank you. I know your time is valuable. I know you have 100 other things to get to today, and get out of your hotel room and go into the heat.
Yes, we are going to go out in the heat a little bit. Luckily, most of the events we're doing are going to be inside, so we don't have to worry too much about it. I was with one of my clients yesterday. He pours concrete here. He's a concrete contractor. If you can imagine 115-degree weather last week. They're out there. They start usually somewhere around 5:30 in the morning, and then try to get done by 1 or 2 o'clock in the afternoon. But I just can't even imagine being out there. He said he left his office the other night after 8 o'clock. It was still over 100 degrees. I mean, talk about guys and women that are just committed to what they're doing. Pretty amazing, the hard work these people put in.
So besides the heat, Dave, what is it like? I guess you'll tell us next week, but going to an event in person again, like I'm totally fascinated by this.
I'm very excited. Now, I'll tell you, I've had enough interaction over the last year. It's not been super problematic for me, but I've been meeting with clients while I'm here, and some of these people have been completely locked up. They've really not gone out and seen people. And the depression, CR, the mental effect that it's taking on people, I don't think anyone can even comprehend the true long-term mental effect that this lockdown is going to have on people. And unfortunately, it's my belief it's going to be maybe even 10 times worse than the pandemic was itself, because I'm seeing it. I'm seeing it day to day in clients' lives. I'm seeing that people that never had depression issues before, that are just sad. They've not been able to get out. They've not been able to keep up with the routine. And again, can they get over it? I hope so. But if they can't, what's the end result of that? A future that looks nothing like what the past did, or unfortunately with some people. And I'd encourage anyone, if you're ever at this point, please call someone, get someone to help you. But end up in point of suicide, of just saying, I can't deal with it any longer. And unfortunately, I'm seeing more of that too. I can't tell you how many friends lately that seen, not close friends, but people that I know from high school that are dying too young, in their 40s, 50s, that just dying, and it's not because of natural causes and medical issues that are happening.
Yeah, definitely heartbreaking. And I think that's the one thing, is that I always tell my wife, we just have to kind of keep always trying to correct the ship, meaning we're always trying to do something better. And I think that's the one thing, is even being on Tom's part yesterday on the webinar, is what you and him talk about all the time, is making sure that once we get our retirement right, we take that stress off and we live longer. I think there's so many things in life that if we can eliminate that stress and eliminate all those worries, we actually live longer, and it helps us to be able to make better choices, and we're able to enjoy retirement versus we never even make it there.
And I think that's the key, CR, is enjoying that retirement. Again, you can live long and be in a nursing home and may not have a very good quality of life, and maybe not be happy that you are even still living. But if you're healthy, keep yourself in that position where that stress is gone. You're in a financial situation, you go enjoy your retirement. I'm seeing people that are just truly loving that time of their lives. They're being able to enjoy all kinds of fun and excitement.
And very well said. And Dave, again, thank you so much for spending an extra 5 minutes with us today and for answering these questions. Gary, thank you so much for your questions that you put in today. And again, if you didn't get your question answered, feel free to reach out to us at the Prosperity guy.com, go to the Contact Us tab, and you can submit a question there. Or you can reach out and come on the show again next week. We're always here at 11 a.m. Central Time to answer your questions. Don't forget, we also have our LinkedIn show. We also have other webinars, and we've got podcasts. We're here to help educate you and help you make the right decision to get to a secure and safe retirement. And again, Dave, thank you so much, and we're hoping we'll see you again next week.
Absolutely.
All right, we'll see you guys.